This stupidly simple strategy is 1000% more effective than any indicator. It's been backtested for over 50 years, and every time I personally tested it in my trades, it's been profitable in the long term. The core of this strategy is linking the highest highs and lowest lows on your chart, and it's called the box strategy. Before I ever knew this strategy existed, I used to overload my charts with tens of indicators like RSI and moving averages in hopes of getting just one right signal. I'd enter trades feeling confident only to get stopped out minutes later. No matter which indicator I used, all my trades ended in losses. Not because I chose the wrong stocks, but because I relied on lagging indicators without understanding the real context behind price movement. After losing thousands of dollars, I knew I was missing something. I stopped chasing shortcuts and got locked in, reading multiple books, research papers, and case studies on what the big money guys actually use. That's when I discovered this guy, Nicholas Darvas. He's a professional dancer who turned $10,000 into $2 million in just 18 months through trading. In his book, he taught the box strategy. At first, it sounded so ridiculously simple that I almost dismissed it. But when I tested it, everything changed. The same market setups that destroyed my account by 10 times my profits. And in this video, I'm going to teach you the exact same strategy step by step. It works on any market, any time frame, and requires nothing but drawing a box. The strategy is so simple, all you have to do is open the previous day's chart. Identify a range where the price is hitting the same high again and again, but doesn't break out. On the flip side, it's hitting the same lows again and again, but not going any lower. Once you identify such a zone, draw a box around those levels. Sounds pretty simple, right? But once you put it into practice, you'll realize there's much more happening than just drawing a box. You gotta master your emotions, unlearn the common beliefs, and internalize the 3 crucial rules of the box strategy. But diving straight into them would be boring without practically showing you how the box actually works. So here's what I'm going to do. I'm going to walk you through the 3 rules, show you how they break your old trading beliefs, and demonstrate how they help you outperform. I won't be using any complicated setups, no indicator overload, just this box, and these simple rules that'll completely shift how you read price action. Alright, let me show you how this actually works. I've opened the previous day's chart here with a 5-minute time frame. Honestly, you can use any time frame, but shorter time frames like 5-minute or 15-minute charts are easier because they show you more detailed price action, frequent ranges, and quick breakouts. For the first step, let's find the highest and lowest points. I'm marking the high right here at the wick of this green candlestick and the low down here at this red candle. By simply connecting these 2 points, the box is now complete. We have our rectangle box ready. The top line right here is our upper boundary. It shows where yesterday's biggest sellers were sitting to push the price down. Once price hits this level, it couldn't go higher because too many people were selling, which kind of created a resistance level. Similarly, the bottom line is where the biggest buyers stepped in to support the price up. It makes up our lower boundary. Now you might ask why these boundaries matter? See, charts don't just form based on 1 day or 20 minutes of movement. They repeat patterns over and over again. And being a trader, we have to learn the context behind these chart formations because these aren't just calculations and big numbers. They are more of a reflection of human emotions, and humans don't suddenly change their thinking just because 20 minutes have passed or a new trading day has started. The buyers who protected the price at the bottom of the box still remember that this was the safest spot to buy. Similarly, the sellers who push the price down from the top of the box still feel that this is the level where the stock becomes too expensive. Remember, these levels stay in the minds of traders, and many of them are waiting for the price to revisit those zones so they can react the same way again. So marking these boundaries is the most crucial step of the box strategy because this leads to the 3 rules of our strategy. Rule number 1, never buy at the upper boundary. Now this is really important because most people misunderstand it like I did. When I first practiced this strategy, I spotted these juicy looking green candles, got carried away by their momentum, and thought, wow, the trend is going up, it's the best time to buy. I would enter the trade right here keeping my stop loss just underneath. It looked like the perfect bullish breakout, but just moments after it hit the upper limit, boom. The trend reversed. I got stopped out within seconds. It wasn't that the market was against me, but because I was missing this golden rule of not buying at the upper limit. Because that's where most institutional sellers reside, ready to dump their positions. They won't let the breakout happen anytime soon. Look what happens here. After touching the highest point, price drops back down into the box, doing exactly what our strategy stated. Then comes the second rule. Never sell at the lower boundary. Why? If you look closely, here, the price is falling to extreme lows. At first, it seems like it'll keep dropping forever, which panics most people and triggers their common belief of not catching a falling knife, so they start shorting at this point. And as soon as the next two candles form, they regret their decision. Because the moment the price touches the boundary, it bounces back up with these strong green candles. As per our strategy, this is the exact moment you should be buying, because this is where yesterday's strongest buyers already proved they'll defend this level, giving us proof that charts are more of human emotions than just numbers. Let's revise what we have covered till now. Draw a box by linking the highest and lowest price point on your chart. When price touches the upper boundary, avoid buying and start selling. Similarly, when the price is at the bottom, wait for it to show a little bounce and start buying. But what should you do when it is neither at the top nor the bottom? It's lurking somewhere in the middle. What should you do then? Well, this exact point leads me to our third and last rule, which is avoid trading the middle zone. See, when price is in the middle of the box, it's in the most confusing part of the market. Neither buyers nor sellers have control there. Think of it like a battlefield. The top is where sellers are strongest, the bottom is where buyers are strongest, and the middle is where both sides are unsure. That middle zone has no clear direction, so the price can move up or down randomly because there are no major traders defending or attacking that area. That's why I call the middle of the box a no man's land. The concept behind avoiding this zone is simple. Institutional traders who actually move the market don't place important orders in the middle. They wait for the price to come to their key levels, the top of the box where they want to sell, or the bottom of the box where they want to buy. Since the middle has no strong buyers or strong sellers, the moves there are usually unpredictable. When you take a trade in the center, your stop loss is unclear and your risk reward becomes terrible. You're essentially guessing. It can go up a little and make you think a breakout is coming, then reverse down and make you panic sell. But when you trade at the top or the bottom of the box, you're trading where real buyers and sellers have already shown their strength, which gives you a clearer story and better probabilities. Till now, we have covered the 3 major steps and rules to practically use the box strategy. But here are a few things you need to know to make this strategy even more effective. So if you want the box strategy to work like a cheat code, instead of just another trading idea, you need to add a few powerful filters that sharpen your entries and reduce false breakouts. The first upgrade is trading with the trend. A box forming in the direction of the overall trend has a much higher probability of breaking correctly. So before you even draw your box, zoom out and check whether the market is in an uptrend, downtrend, or completely sideways. Next, use volume as confirmation. A true breakout almost always comes with a spike in volume because that's when A-list players step in. If you see the price pushing out of the box but the volume is dead, it's probably a false breakout, so avoid it until you see volume. Another trick is using time filters. Most people don't talk about it, but boxes formed during high liquidity sessions like New York tend to break cleaner than boxes formed during choppy, low-volume hours. Finally, add a test-retest rule. Now, this rule is really simple and saves you from high-risk situations. You should only trade after price breaks through the box, pulls back, and proves that the breakout is real. This one simple rule alone can filter out 70% of fake moves. With these tweaks, your box strategy becomes not just effective, but dangerous in a good way. Now, let me summarize everything. This is a price action strategy, not a holy grail. Some days the price will break through your box and keep going. Some days it'll chop around and hit your stop. That's trading. But what this strategy gives you is clarity and consistent rules, so you don't end up guessing every morning before your trades. Instead, what you would do is open yesterday's chart, draw your box, revisit the rules, don't buy at the top, don't trade the middle, and don't sell at the bottom. Wait for price retest, confirm with volume, apply time filters if you have to, and keep a manageable risk-reward ratio. As always, practice first because this isn't a holy grail, but it is clarity. And clarity is the only thing that makes money in this game. Stop trading in the middle, stop buying at the top, and never sell at the bottom. Trade the boundaries, trade with the big players, and use proper risk management. If this strategy saves you just one losing trade this week, you owe me one thing: smash the like button and subscribe. We're here to trade smarter, not harder, and I'll see you in the next one.